Hello guys, welcome to CMS series part 1 Planning and Performance. So today we are going to discuss the second part of unit number 1, that is external financial statements. In our previous lecture, we have discussed a brief about what are the external financial statements. Now, in today's video, we will discuss the statement of financial position. The statement of financial position is also known as the balance sheet. Now, first, what is balance sheet? If we go for the book's definition, what it says, the statement of financial position, also called balance sheet, reports the amount of asset, the value of asset, liabilities, the debt, equity, net worth of the business, and their relationship in a moment of time, such as at the end of fiscal year. So we can say a balance sheet is a financial statement that contains details of a company's asset or liabilities at a specific point of time. It is one of the main financial statement that we have discussed. Like we have already discussed, there are set of financial statement. Financial statement includes cash flow in it, income statement, then statement of changes in equity and balance sheet. So we will in our today's lecture go in a detail what is balance sheet, what is the purpose of balance sheet, all these things that are related to balance sheet, what are the categories, what are the aspects that we put in the balance sheet. This all we will discuss in our today's lecture. Now the first thing in our today's lecture is balance sheet overview. Now what is balance sheet? So first thing is balance sheet reports the amount of assets, liabilities and equity. As I already discussed, balance sheet contains two sides, asset side and liability side. And on the same liability side, we will put the equity. Now, what is the thing? Why we need balance sheet? We want to know what is the current value or what is the value of asset that has been used in the business. So from where we will get the value? We will get this value from balance sheet. We want to know what are the things that we are responsible or that we have borrowed. What are the things that we are going to pay in future. So these amounts we will only come to know from the liability side. In the equity is something that a owners owns this money. An owner can claim this money anytime. So these are the three things that we report in the balance sheet. Now, balance sheet help us to assess the liability, financial flexibility, efficiency, capital structure, risk, solvency, and overall financial health. Anything related to the finance, we can get it from the balance sheet. Like what is the position of company? We will only come to know after reading it. The next thing in balance sheet overview is the accounting formula. The formula is total assets should always be equal to the total of liabilities plus shareholder equity. That what are the types of asset categories and liabilities? All this we will discuss in our today's lecture in detail. So for now, just keep in mind that formula of balance sheet is the total asset should always be equal to total liabilities plus shareholder equity. Next is a balance sheet provide a snapshot of a company financial position at a specific point in time. Like we cannot say the figures that we are looking in balance sheet are the live figures. They are not live. They are not live. They are like correct up to a specific time. For example, when the balance sheet was prepared, until that, these figures provide you the snapshot of a company position. After that, balance sheet will not be providing you the exact information. Somehow you will get these things, but for the balance sheet, it will only provide you on a specific time. The last thing in the balance sheet overview is it must adhere with the accounting standards. I already discussed with you. There are two accounting standards that we followed. First one is GAAP. Second one is IFRS. In CMA, we will discuss most of the things that are related to GAAP. And we will also discuss where GAAP and IFRS have different opinion on a specific thing. The next thing after the balance sheet overview is elements of the balance sheet. There are three elements of the balance sheet. The first one is equity, that is also known as owner equity. Second thing is asset, and the third thing is liability. First of all, what is equity? Like, say, a company has to raise the fund to support their ongoing operation. Now, from where they will get the fund? They will get this fund from external debts. They will get this from investment from their owner, raising capital from outside of investor, and the business earning. So these are the things where the company can get their fund to support their operation. Now, without such a capital, business cannot procedure goods or services. Like company cannot produce anything without the money. So this money that has been invested by the owner, or that has been where the company get their money from raising their capital, is known as owner's equity or only equity. Now, it is a portion of company's asset that owner can claim. It is what left after subtracting all the liabilities from the asset. The remaining amount is owner's equity. Owner equity is listed on company's balance sheet liability side. It grows when owner increase their investment or company increase their profit, the equity will go up. And at the same time, if the company start making losses, the equity will go down. After owner equity or equity, the next element of balance sheet is the asset. Now, what is the asset? Asset are the resources controlled by the entity as a result of past event. They represent probable future economic benefits of entity. For example, it includes inventory, accounts receivable, investment, property, plant, and equipment. In a financial accounting, asset is any resource that can be controlled by the company or an economic entity. It can be anything, tangible or intangible, that can be used to produce positive economic value. Asset represent the value of ownership that can be converted into cash. Although cash itself also considered as an asset. Now, we already know what are the assets. So, I already mentioned the asset can be tangible or intangible. So, these are two classes. Other than these two classes, there are also some subclasses. Asset can be current, non-current or fixed as well. Like, in detail, we will discuss what are the current and non-current asset, but for now, I will just give you a brief. Current asset are the asset that are going to utilize or that are using that something we are going to consume within 1 year or the accounting period that a company has decided. And the non-current asset are something that are going to useful life for more than 1 year. So in detail, we will discuss these two parts in our today's lecture later on. The last thing in our elements of balance sheet is liabilities. What are liabilities? So we can say liabilities are the part of obligation of an entity or a company that is arising from the past event. For example, you have take some stocks or you have purchased something from a person and you have not paid them. So it's your liability to pay that person. So their settlement is expected to result in an outflow of economic benefit from the entity. So there are, we can say, some loans. For example, you took some loans, they are payable, it will become your liabilities. Or account payable is become your liabilities. Now, liabilities are recorded on the right side of balance sheet. Liabilities can be contrast with asset. Liability refer to that thing that you owe or you have borrowed. But the asset are something that you have owned, that is under your ownership. So liabilities can be short-term and long-term as well. So short-term liabilities are due within an accounting period of 12 months, and the long-term liabilities become liability or more than 12 months. So there are two categories of liabilities. The first one is a current liability. Second one is non-current liability. And the third one is contingent liabilities. Now, for the current and non-current, we will discuss in our today's lecture, but I will just give you a brief about what is the contingent liabilities. Contingent liabilities are recorded as a potential, and if there is 50% chance of occurring. For example, you are undergoing with a lawsuit, you have some warranties, so it will be go 50-50 chance. Owner's equity, the first element of the balance sheet. First of all, what is owner equity? Owner equity, also known as shareholder equity for corporations, and it represents the owner residual interest on asset after deducting liabilities. It measures net value of a business from a property of its owner. Owner equity can be calculated from deducted total liabilities from total asset. Now, what are the components of owner equity? The first component is the capital contribution, the amount of money or assets that owner have invested in the business. For corporation, it includes common stock or preferred stock. The second component of owner equity are retained earnings that a companies earn from doing the business operations, profit that a business earn over a time within a company rather than distribute as a owner as a dividend which are not distributed will be considered as a retained earning. Additional paid-in capital is also the component of owner equity. For example, the value of a stock is $1, but in market it's trading in $3 or $4. So the additional paid-in capital, the excess amount paid by investor over the par value of a stock is also the component of owner's equity. And treasury stocks, the shares we are outstanding, but we have repurchased that. So these are also the part of company's owner equity. Regarding owner equity, we should keep in mind there are three types of owner equity. The first owner equity is the sole proprietorship. That is typically referred to as an owner's capital. The single person is investing and he is the owner of all over the business. The second type of owner equity is the partnership. Each partner share equity is accounted for individually. For example, a person is investing 70,000. He is accountable for he is the entitled for 70,000. The second person is investing 30,000. He is the owner of 30%. So these are what we call the partnership. And then there is a corporation. Corporation equity is divided into common stock or preferred stock and retained earning. And with the combination of these three things, we will get the corporation equity. Now, equity in the balance sheet. In balance sheet, equity has three categories. The first one is share capital, second is retained earning, and the third is other comprehensive income. So don't worry about this thing. We will discuss in detail this thing. Like what are the income, what are the other comprehensive income. This is something we will discuss in detail. Now, understanding owner equity is crucial for assessing the value of financial health of a business. It provides the insight into what the owner would theoretically receive if all assets are liquidated and if all the liabilities are paid off, that much amount will be owner will receive. This is just a theoretical way. It can be more, it can be less. The next thing is the asset. Now, what is asset? Asset are the thing your practice owns that has a monetary value. No, making it in a simple language, an asset is any resource owned by individual or entity, and that is expected to provide you future economic benefits. Assets are fundamental to the operation and the value of business or a person or a personal financial standing, as they represent resources they can use to generate revenue, they can use to pay debts, or they can also use to fund the operations. Now, what are the characteristics of an asset? asset has an economic benefit. Assets are expected to provide future economic benefit through revenue generation or cost saving. Assets are the ownership. The entity or individual must control the asset, meaning they have a legal right to access or benefits, or they have legal rights of accessing the benefits that it provides. The next thing is measurability. The value of asset must be quantifiable, or we can say it must be in the monetary terms. Reliability of assets. The cost of asset can be reliable and measured and verified. We can reliable on the figure that we are going to give on asset. No, how we are going to value our assets. The first thing is the historical cost. The historical cost is the original purchase price of the asset when we purchase the asset. Next thing is the market value. The current fair market value if the asset is sold today. Depreciated value. For tangible assets like asset, equipment, after counting depreciation over a time, and the amortized value for intangible asset after the accounting of amortization. The importance of asset. Now, asset provides the snapshot of an entity financial health and its ability to generate future income. We can only come to know how much future income that is expected to earn by a company from accessing the assets value. Now, liquidity. Liquidity, current assets in particular essential for accessing company liquidity and ability to meet short-term obligations. For example, if a company has more current asset, we can know company can liquidate more. It can pay the short-term obligation as soon as possible. Like, asset can be used as a collateral for also. Like, for example, if you are going for a bank to getting some loan for your company, now company should have some collateral, some security to give the bank for taking the loan. Asset is crucial for making investment decisions. Like, understanding asset is crucial for making informed investment decision. Whenever a person is going to invest and he says the company has assets, so he will also know, he will get some idea how to make decision for his investment. Now, there are two types of assets. The first one, that is current asset, and the second is non-current asset, and we also call it long-term asset. What are current asset? So, any asset is classified current on the statement of financial position if it is expected to realize in cash or consumed or sold within the operating period of 1 year. So, any asset that can be used within 1 year, we will consider it as an current asset. Now, there are some examples of current asset. What are cash and cash equivalents? Cash, we know what is the cash, but cash equivalents are like banks, checks, or anything that is equal to cash, and that is very easy to convert it into cash. Second is individual for trading, or if there is anything available for sale. So, I think that is receivable. For example, we have sold something to a person, but they have not paid us. So, this receivable is also our asset until or unless they pay. Then the inventory is also an asset because it will also give us some monetary value or some value in future. And the prepaid expense. That expenses we have paid in advance become our asset. For example, we have paid a rent of the whole year. Now it will be realized throughout the year, but we have already paid in advance. So these kind of expenses that are paid in advance are considered as prepaid expenses and also become our asset. The next thing is non-current asset. A non-current asset is a long-term resource owned by a company or an individual, and it is not expected to convert into cash, or it is not expected to use within 1 year. Now, some major categories of non-current asset are investment funds, property, plant, equipment, or intangible assets. Now, these are the assets we will not expecting to convert them within a year. For example, if you have gone and you have purchased a building for your company, for the offices, so you will not expect to sell this building in 1 year. you will try to use this building for 3 years or 5 years or maybe 10 years. So you will use it more than 1 year. So these kind of assets are considered as long-term asset. So it will be used for a long time. The next thing is intangible asset. Now, what are the intangible assets? These assets that we cannot touch or see, but they exist. For example, your goodwill that exists, that has a value, but you cannot see it, you cannot touch it. So these are some kind of an intangible asset, and deferred tax are also considered as an asset. For example, you have paid some advance taxes, so you will not use these taxes in a year. You have to wait until you are going to file your next year tax. So deferred tax is also considered as non-current asset or long-term asset. The next thing is the liability. Now, liabilities are the financial obligation or debts that an individual or entity owes to other, which is expected to be settled over a period of time, or we have to settle it over a period of time through transfer of economic benefits such as money, or we have to provide them the goods or services. In accounting, liabilities are classified into different categories based on their due dates and their nature. So, there are some characteristics of liabilities. The first thing is it is an obligation. There must be present obligation from arising from the past event. For example, you have taken some services from a creditor, you have taken some goods from a person, so you will pay them in future. No, the event has been done in past already. There will be an obligation in now, the settlement. Obligation will result in an outflow of resources, embodying economic benefits. That can be goods, that can be services, that can be cash as well. And the third thing of the liability, it should be measurable. The amount of obligation can be reliable and we can measure it. So, what are the importance of liabilities in a financial position? Liabilities, along with the assets and under equity, are a crucial part of balance sheet that provides a snapshot of a financial position of an entity. Now, liability also help us for liquidity analysis. For example, you have an asset of 100,000, but the liability is of 95,000. So, what do you think? The company is in a good position? So, we cannot say it's a good position because after paying all the liabilities, there are only 5,000 to distribute. If there are more than one owner of a company, 5,000 will not enough for that. So, for liquidity analysis, we should go for the both assets as well as liability. Liability also help us in assessing the risk associated with the entity's financial obligation. So, as I consider an example, there is a business with the following liabilities. It has a account payable for $20,000, short-term loan for $50,000, and accrued expenses are $5,000, and long-term loan are $50,000. So, the total liabilities of a company will be 90,000. So, 90,000, we will say our $90,000 are on a risk. Why? Because when we are going to liquidate, we cannot take the money before paying the $90,000 that has been liability on us. So, these are listed in order to their due dates. Current liabilities are first, and then with the non-current liabilities. In summary, liabilities represent the debts and obligation of an entity that need to be settled in future. They are essential for understanding entity health, liquidity, and risk profile as well. There are two categories in liabilities as well. The first one is current liability, and the second is non-current, or we can say these are the long-term liabilities. So, what are the current liabilities? Current liabilities are expected to be settled or liquidated during the longer to the next year operating cycle. Generally speaking, within the 1 year of balance sheet date. The following are the some categories of our current liabilities. Now, what are those categories? The first thing is the trade payable. Trade payable for the item into operating cycle. For example, you have purchased some material, you have purchased some suppliers that we will use for producing goods or services for sale. So this trade payable our current liability. Other payable arising from operations such as wages, salaries, rental, taxes. These are the current liabilities that we have to pay. Unearned revenue are also our liability that are arising from the collection in advance. For example, delivering good or services, we have sold something but we have not collected the money from it till now. So this is also considered as current liability. And the other obligations. Now, what are the other obligations? It can be expected ordinary course of business. Okay, during like sinking our fund, we are making our provisions, we are paying our bonds on non-current debt, so creditor and unpaid expenses. These all are considered under the current liabilities that has to be settled within 1 year of time. Non-current liabilities. What are the non-current liabilities? Non-current liabilities are those not qualified as current. For example, there are something that we cannot realize or that we cannot pay within 1 year. So these are our non-current liabilities. The non-current liabilities are settled after 1 year or more than 1 year, that are required more than 1 year to be settled. So what are some major categories of non-current liabilities? So first thing is the long-term debts that are bond payable, long-term loans. We have got some mortgage. So these are our non-current liabilities or long-term liabilities. Deferred tax liabilities. There are lease waivers. So we can say the lease we are getting for 10-year or 5-year lease. So lease is our liability. Pension. We will pay the pension to our employee at the end of their services, and if our worker is working for more than 5 years, 10 years, so this is our liability to pay him, and we will pay him after more than 1 year. So this is also on non-current liabilities. Long-term provisions. For example, if there is a legal dispute, we will pay it. Maybe it will take 1 year or 2 years to solve this dispute. So this is also considered as a long-current liability or long-term liability. And other, like we can say, deferred revenue for long contracts. For example, we have a contract with a company, so we will pay them in the 2 years with over a period of time. So this long-term contracts that we have to pay also considered as a non-current liabilities. Now, talking about the stockholder or owner equity, we have already discussed the stockholder equity includes 4 categories. So the 4 income categories, when we are combining this, we will get the stockholder or the owner's equity. The first thing is the capital distribution. Capital distribution is the amount they have invested in their, when the business were running operation, to run this operation, they got some investment, they got some capital. So this money is considered as a capital distribution. The second thing is the retained earning. Now, what are the retained earning? A company gets some money, do some operation, produce some goods or services, sell them and earn some money. Now, there can be 2 scenarios. The scenario 1 is the company will distribute the money as a dividend. And the second scenario is company will distribute some money as a dividend and keep some money. So the money that the company is keeping with them is considered as a retained earning, and it goes in the stakeholder equity. The third thing is the treasury stock. Now, what is the treasury stock? Treasury stock are the stock that has company issued, but over a period of time, company have repurchased these stocks. So these are considered as a treasury stocks. The last thing in owner's equity is the accumulated or other comprehensive income. For example, you have purchased the land for your office or for your business, you have purchased some kind of a properties. Now, after some time, you realize you don't need this property. You sell them. So this is a other comprehensive income. You have earned it, but not from your main source of income. Same goes for you have sold some scrap. So these other income are considered as other comprehensive income. permanent or real accounts. Now, balance sheet elements are always a permanent accounts. A balance sheet comprises real account, also known as permanent account. Now, they carries ending balance into their next accounting period, reflecting the ongoing financial position of a business. These accounts include liabilities, owners, equity, and asset. Asset we have discussed, such as cash, accounts receivable, inventory, and anything that is owned by the business to continue into the future periods. Now, liabilities. Liabilities are also permanent account. That includes account payable, short-term loans, and each and everything that need to be settled in future. And the owner equity, that is encompassing like a common stock, retained earning, additional paid-in capital, and other residual value of interest that the owner has to get after then the liabilities are paid off. Real accounts are not closed at the end of accounting period. They are carry forward to the next accounting period. For example, you have purchased something, you have paid them the money. Now this account is closed. Balance sheet account, we cannot say the asset is now closed. It's a real account and it keep on using like this year opening balance will be the in the last closing balance and the year of end, and then after closing and making all the and adjusting entries, we will continue it to the next year. No, it will keep on going. So that is what we can say. It's a real account or a permanent account that we are not going to close with any period or with any period of close end. Major balance sheet note and disclosure. Balance sheet does not only include the asset, liabilities, and owner equity. Note disclosure are also very important part for the balance sheet. What are note disclosures? For example, you have a record asset that is worth, let's say, 100,000. But you know that the asset condition is not very well. So maybe in 1 or 2 months, we are going to change the asset. Or there is a change in technology, so we have to change the asset for a better production. So what you will do, you will write a note on it. You have invested in a security. Now, your prediction is in 1 month or 2 months, the security will go up or it can be go down. So you have to write it in our note and disclosure. So because when the balance sheet will be published and it will go to the investor or for the analysis, so they people will rely on the figure. So adding this note will create a transparency in our accounts. We will say that there are some uncertain things that are expected to become. For example, we are going to a last week and we know that there is a most of the chance we are going to lose that case. So we are going to lose that money. So it must be included in the note and disclosure below the balance sheet. So just whoever is using the balance sheet figure will be more reliable and we will have a more flexible information to make decisions. Now the last thing in our today's lecture is limitation of balance sheet. What are the limitations? We all know the balance sheet is very good for analysis and decision making, but still there are some limitations that we have to keep in our mind. First is the historical cost. Assets are recorded at their original purchase cost, which may not reflect the current market value. So for example, if we have purchased the land, for example, 5 years ago for $20,000 or $30,000. So now the land price will appreciate. It will not be the 20,000 or 30,000 now. Maybe it will go more than 200,000. Same for the asset. You have purchased an asset 2 years or 3 years back. Now asset value can be more. Asset value can be less. So this is first limitation. It is assets are recorded at their original price or purchase cost. Second is intangible asset. No, some intangible asset like brand value and intellectual property will not be fully captured. For example, an iPhone or an Apple. Do you think they can actually guess what is their brand value No, they cannot assume. It's just on an assumption. Intangible assets are recorded just on an assumption. And there, and also there are some goodwill. So goodwill can be go up, can be go down as well. So intangible asset, we cannot fully capture them in our balance sheet. Next thing is snapshot in time. Balance sheet provide financial snapshot at a specific date, which may not reflect ongoing changes in financial health. So we can say the balance sheet is not showing us the live figure of the assets or liabilities. We are just getting those figure on a specific date when it was created. So we cannot say the ongoing changes of financial health is also reflecting in the balance sheet on the same time. Then subjectivity in valuation. The next limitation is that the estimate and judgment, such as depreciation method and provision, can introduce subjectivity. For example, I am depreciating my asset at 5%, but in market, actually the asset depreciation is 7%. So this can also be a limitation of balance sheet. Like we cannot give the exact figure. Then omission of non-financial factor. We are not writing the non-financial factor. For example, market condition. We cannot convert the market condition into figures. So this is also a limitation of balance sheet. And now management. Whether our management is working on a very good quality, what are the quality of management? We cannot convert it into figure. This is also a limitation of our balance sheet. Does not reflect the cash flow. It shows the cash flow. It is critical to understand the liquidity of operations. For example, I will show the cash in the beginning is $10,000. But if you are looking at my balance sheet after 1 month, it will not be $10,000. It can go down because I am paying some expenses. My cash is in a flow. So we cannot reflect the exact cash flow in our balance sheet as well. So this is all for our today's class. So if you have any question, you can write them in comment section. And also I am expecting that if there are any improvement that I can do to improve the video, you can also suggest me that as well. So you have understand our today's class. See you in the next class. Thank you.